In this presentation, we will come to understand why nations desire to trade with one another. There have been many theories that have described the different theories regarding trade flows between nations. However, we will focus on why many economists believe unrestricted free trade between nations raises the economic welfare of countries that participate in a free trade system. Only governments play a proactive role in promoting national competitive advantage in certain industries, which has important implications for management practice. First, let's be clear. Free international trade does not exist. Every country, even the United States, has some government regulated barrier that impacts the flow of goods and services. Despite the rise of multilateral free trade agreements, the fine details reveal the level of protectionism that each country wants for certain industries in their respective countries. Without going into too much detail, it is important to understand the key economic theories that have driven international trade policies over the centuries. Yes, centuries, as this economic concept has been around for 1,000 years. In economics, the principle of absolute advantage refers to the ability of a party, an individual, a firm, or a country, to produce a good or service more efficiently than its competitors. In 1776, Adam Smith first described the principle of absolute advantage in the context of international trade through the use of labor as the only input. Since absolute advantage is determined by a simple comparison of labor productiveness, it is possible for a party to have no absolute advantage in anything. Remember, the Industrial Revolution was in its infancy in Europe and the United States. In 1817, David Ricardo presented his theory of comparative advantage to explain why countries engage in international trade. Even though one country's workers were more efficient at producing every single good than workers in other countries. He demonstrated that if two countries capable of producing two commodities engage in the free market, then each country will increase its overall consumption by exporting the good for which it has a comparative advantage, while importing the other good. This is based on the theory that there existed differences in labor productivity between both countries. The theory implies that comparative advantage, rather than Smith's absolute advantage, is responsible for much of international trade. Remember, both theories are focused on labor and labor productivity. Heckscher-Ohlin theory is an enhancement to the theory of comparative advantage in international trade. It is based on the theory that those countries in which capital is relatively plentiful and labor relatively scarce will tend to export capital-intensive products and import labor-intensive products. On the other hand, those countries in which labor is relatively plentiful and capital relatively scarce will tend to export labor-intensive products and import capital-intensive products. The product life cycle theory is an economic theory that was developed by Raymond Vernon in response to the Heckscher-Ohlin theory and to expand upon the observed pattern of international trade starting after World War II. The theory suggests that early in a product's life cycle, all the parts and labor associated with that product come from the area where it was invented. After the product becomes adopted and used in the world markets, production gradually moves away from the point of origin. In some cases, the product becomes an item that is imported by its original country of invention. A commonly used example of this is the invention, growth, and production of the personal computer and many of its ancillary products, most of which were invented in the United States. Today, new trade theory developed in the 1970s and 1980s is a collection of economic models in international trade, which focuses on the role of increasing returns to scale and network effects. New trade theorists relax the assumption of constant returns to scale, and some argue that using protectionist measures to build up a huge industrial base in certain industries will then allow those sectors to dominate the world market. One of these new trade theories is Michael Porter's diamond theory of national advantage. The diamond model, also known as the Porter diamond or the Porter diamond theory of national advantage, describes a nation's competitive advantage in the international market. In this model, four attributes are taken into consideration: factor conditions, demand conditions, related and supported industries, and firm strategy, structure, and rivalry. According to Michael Porter, the model's creator, these determinants create the national environment in which companies are born and learn how to compete. The other determinant that is key to Porter's diamond model, the role of government in Michael Porter's diamond model and how it acts as a catalyst and a challenger. It is to encourage or even push companies to raise their aspirations and move to higher levels of competitive performance. They must encourage companies to raise their performance, stimulate early demand for advanced products, focus on specialized factor creation, and to stimulate local rivalry by limiting direct cooperation and enforcing antitrust regulations. Let's be clear, Porter's theory holds many truths, but so does the other theories presented. While no one theory holds all the answers, it may be best to say that each of these theories complements the others to help describe the patterns of international trade. So what does this mean for you as a leader and manager in the world of global finance? First, one must analyze the locations in which to conduct international business. As the theories presented, and as we have seen over the past 50 years, different countries have particular advantages in terms of supply and demand. From a profit perspective, productive activities should be located where they can be formed in the most efficient and cost-effective manner. It is not unusual for a global company to have R&D facilities in one location, production and manufacturing in multiple locations, and support activities throughout the globe. Second, first mover advantages in terms of production of a particular new product may subsequently dominate global markets. In the 1980s and 90s, two of the world's largest manufacturers of cell phones were Motorola and Nokia, and they dominated the global market. However, in 2007, the iPhone was the first truly smartphone launched into the market and was primarily only available in the United States. Within 10 years, Motorola and Nokia phones and their market dominance had disappeared. iPhone, by being a first mover and gaining advantage in all aspects, remains the dominant player in the global smartphone market. Finally, government policy plays a role in the decision-making of all companies, regardless of their global activities. Government policy is not made in a vacuum, as it is influenced by the lobbying efforts of corporate managements. As a global finance leader and manager, one must understand a government's view on international trade, especially when analyzing investment opportunities outside of one's domestic market. The globalization of the world economy is happening at a faster rate each and every day. Many countries continue to pass legislation to hinder the free flow of goods, services, and capital with the stated intent of protecting their economies and people. While the implementation of some regulation could prove to be useful, the majority of countries would greatly benefit from freer, less restrictive trade policies in order to increase the globalization of their market.